Recent geopolitical developments in the Middle East have grown traders' needs for 24/7 monitoring of market impacts. As traditional exchanges have not yet introduced round-the-clock trading and are closed over the weekends and holidays, traders have turned to other options to take advantage of the heightened volatility around the weekend. It is no surprise that military action is usually done when markets are closed, with the goal to avoid immediate, often irrational market behavior and give market participants enough time to look at the facts and form well-informed opinions. The rise of perpetual futures listings on traditional assets has opened up the possibility to trade instruments like oil and gold even when classic exchanges like the CME are closed. But these assets still haven't gained the popularity and recognition of Wall Street, with volumes being drastically lower than on their traditional counterparts. On crypto venues, you'll see order books that are thinner, funding rates that swing wildly, and gaps that last until Monday morning. This means price discovery is limited, and therefore often imperfect. That imperfect price discovery is where opportunity lives, and this is something we have recently seen in gold over the weekend. The weekend dislocation showed up in two ways: cross-venue and gap to spot. Two popular choices for perpetuals are Binance and Hyperliquid. Both have gold quoted in USD stablecoins. Perpetuals on Hyperliquid peaked around $5,464, while perpetuals on Binance printed around $5,600, a more than $100 divergence on contracts that nominally track the same ounce of gold. On the other hand, when traditional markets reopened the following Monday, the front month on the CME Group and spot quotes opened at a different level again, leaving the weekend traders with three different reference prices. That triple split, Hyperliquid, Binance, and the Monday spot/CME open, is exactly the kind of dislocation that arbitrageurs aim to exploit. Unfortunately, although it makes sense on paper, it is messy in real trading. What makes exploiting that gap so troublesome is a mix of margin, settlement, and liquidity frictions. Perp exchanges settle in stablecoins, so you must hold and move those coins between venues. You can't just net a long on one platform against a short on another, as each platform enforces its own margin and maintenance rules. That means a furious move against your short leg can trigger a margin call or automatic liquidation on one exchange, even while your long on the other is profiting. Add leverage, and that timing mismatch becomes lethal. One leg gets wiped before convergence happens. Liquidity and execution also are troublesome. The deeper book will absorb size with less slippage, while the thinner book will move more on your orders, so you have to size to the smaller book and accept limited throughput. Funding rates, which perpetuals use to anchor to spot, can differ widely between venues during stress. Those funding flows over a multi-day hold can convert an apparent spread into a loss. Both trading and withdraw/convert fees, and the cost and time of turning USDC/USDT back into fiat or another stablecoin, eat into the gross spread. Operationally, KYC/withdrawal limits, API rate limits, maintenance windows, and intermittent exchange issues mean you can get stuck with one side of the trade you can't close quickly. But here's where it gets more interesting and more realistic for most traders. Instead of trying to run a pure cross-exchange arbitrage, you can treat weekend perpetual pricing as an informational lead indicator for how spot gold might open on Monday. The key insight is this: even if crypto perps are thin and imperfect, they are still the only live price discovery mechanism when traditional markets are closed. That makes them noisy, but informative. After the weekend, you essentially had three reference prices: Hyperliquid around 5,385, Binance around 5,436, and the spot Monday open on the CME Group that was close to the Hyperliquid one. So the question over the weekend was not, can I arb this? But rather, which venue is closer to the price that traditional markets will validate on Monday? That opens the door to directional positioning. If crypto perps overshoot dramatically relative to historical gap behavior, you can frame a mean reversion trade. For example, if Binance spikes to 5,650 in thin liquidity on emotional flows, but historical crisis gaps in gold tend to open 1 to 2% higher rather than 5%, you might position short into the spike, not because you expect convergence with Hyperliquid, but because you expect Monday's regulated open to print lower than the emotional weekend high. On the other hand, if both crypto venues are bid aggressively and funding remains persistently positive, meaning longs are paying to hold, that may signal genuine positioning demand rather than just a thin book squeeze. In that case, you could treat the weekend range as a discovery zone and position long into Monday, expecting traditional participants to validate the move once futures reopen.